Welcome to the Monocle Banking Podcast, as always curated by Monocle Solutions. I'm your host, Michael Avery, and this week we're asking, where is the money going to be made in the third quarter? Well, as we know, markets have been in a particularly mischievous mood this year. War in the Middle East, oil briefly behaving as though the world was running out of it, inflation returning from the dead, central bankers changing their minds, or at least investors changing their minds about what central bankers might do, and enough anxiety around AI to sustain several technology bubbles all at once. So you might reasonably have assumed that the sensible response would have been to hide under the desk with a money market fund. The trouble is, the markets don't operate like that at all and didn't cooperate. We saw the S&P 500 kept pushing higher. We saw the rand strengthen. South African government bonds rallied. Banks on the JSE had a rather good quarter. And I think investors who waited for the world to calm down again and become a bit more coherent and investable, probably still waiting for that. So it's time to find out where the money is going to be made in the third quarter. And Anchor has just released their latest report, which makes for fascinating reading. Joining me are Anchor Capital Chief Investment Officers Peter Armitage and Nolan Wapenaar. Gents, welcome. Peter, let's just begin with the apparent contradiction at the center of your outlook. The geopolitical risk remains unusually high, yet Anchor has become more willing to take on investment risk. So what has changed sufficiently to justify that move?
I think one needs to separate out from a global and local perspective. Obviously, a lot of what happens locally is informed by offshore. But globally, you've got two kind of competing forces from a valuation and performance perspective. One is the risks, which are largely centered around the war, oil, and the transmission of higher oil prices into inflation. Means bond yields have gone up, which should theoretically, generally over time, that reduces equity valuations. So you've got that on the bear side. On the positive side, you've got unprecedented investment in technology in a changing world. And that has trumped, sorry to use the phrase, the Iran war issues. And ultimately, people invest in businesses because they think the value of businesses will go up. And people don't want to be left out of that trade. So, if you brought that back home, picture having 20 power stations being built in South Africa at the same time. The implications on construction, on retail spend, on the whole infrastructure around that, and that's keeping the US economy very buoyant and keeping the market buoyant, and hence people are looking at the whole Iran war issue. They're kind of looking through it and saying that will end, and this is not a permanent mechanism. And valuations have come off 10% from their highs in the US. Locally, it's a little bit different in that you've had the markets down 5% for the year. So things are not materially worse than pre-war. The SA story continues to get a bit better. But, we've got shares at 5, 6, 7, 8p multiples. In America, you have to pay 25 for the same thing.
Yeah.
So we've got a double-digit expectation from local and global equities. And if, we obviously think you should diversify. But if you're to choose one in the next 12 months, we think you could well get a better return out of local equities.
That's really interesting, and we'll come back to that. I want to kick off with probably the big talking point in markets. Let's park the geopolitics of the Middle East to one side for a moment and talk about AI and this investment cycle, which is being described by so many as structural rather than cyclical. And maybe, Nolan, to bring you in on this point, what evidence would tell you that this is a genuine productive investment rather than the familiar corporate tendency to overbuild whatever is currently fashionable? Because there are such eye-wateringly large sums in terms of capex that are being spent, as Peter mentioned. You imagine 20 power stations being built. I mean, that's effectively what these data centers are. And there is a sense that all these mega cap tech companies are investing because they have to. There's this fear of losing out and being left behind. But that has also led to questions of this being a bubble. And there's lots of circular funding in the whole ecosystem as well. So how do you, as managers of capital, try and sort the wheat from the chaff in the AI space?
Well, thanks, Michael. I'm actually going to ask Peter to join in as well, possibly something that's more his area of expertise. But in short, you've hit the nail on the head. Is it a bubble, or is this productive spend. And that's the ongoing debate within the markets. And to be honest, I can find a bunch of people that will sit on either side of the argument. And it's probably an argument that's going to rage for a while. From my perspective, I can't necessarily quantify, is all of the spending justified? Maybe it is, maybe it isn't. What I can certainly say is while the hardware spending is taking place, while the electricity production spending is taking place, while the infrastructure is being rolled out, there are a lot of suppliers for that who are actually benefiting, and those suppliers are making real sales, and we do see opportunity there. The other aspect of it, though, is if I look at our business, or if you look at many businesses, are we active in AI? Yes, we are finding that we become more productive. We find that our actual daily activities seem to be more focused. So from that perspective, we are seeing the benefit ourselves. And we look around at the big corporates, and you are seeing expenses on AI. You're seeing the token costs come through. We see them on our side. And I think that is something that is going to become more and more just a part of business, which augments your human capital.
So, Peter, to bring you in then as well, I mean, who's taking the greater risk then? Is it the semiconductor and the infrastructure suppliers who, to Nolan's point, are receiving the money now? Or is it the large tech platforms spending the hundreds of billions in the hope of monetizing AI later?
No, it's absolutely the guys spending the money. You know, the memory and semiconductor and infrastructure players where the money is being spent. And they're not really taking a risk. They're just getting an order book, which is unprecedented. And all indications are that can continue for a few years. The people who are taking the risk are the people who are building all of the capacity, who need people like Anthropic, which is Claude, and OpenAI, which is ChatGPT. Ultimately, they need the consumer and corporates to spend money on those businesses. And that's where you talk about the circular referencing. So somebody like NVIDIA, who's a major supplier of chips to the data centers, you know, they're now getting in a deal with OpenAI to help them build data centers to create the capacity. And in order to build the data centers, they need NVIDIA chips. But NVIDIA is actually in the golden position here. NVIDIA is not building the capacity. NVIDIA is making a 65% operating margin and charging ridiculous prices. You know, it's marking up its cost of sales 4 times to sell to Microsoft and Google and the like. So they've got the massive free cash flow. You've actually got businesses in very different places. NVIDIA's got all the cash flow and receiving all the money from Google and Microsoft and Amazon. And they're just trying to find places to invest it. Google, and that's why we're watching the AI results at the moment. You know, Google, Meta, Microsoft, these are massive cash flow machines. They still are. But they're now spending all of their cash flow in future capex.
Yeah.
So it's very different to the tech boom and bust of 2000, where it was all about new businesses who didn't have business models and were being funded by equity. This is now good old established businesses making huge cash flows. And they're simply directing their cash flows into the capex world. So the risk is ultimately this all works if the consumer and the companies believe in AI and spend on it, because everybody's creating this capex in order to service that demand. But it's still quite early days. You know, Anthropic, which is Claude, was doing a year ago $10 billion of sales a year. It's now up to somewhere between 50 and 70. That's in 1 year. And the speculation is that goes up to 150 in a year's time. So as Nolan said, we as a company, we're spending it from nothing a year ago, and now spending a few $1 million on tokens and capacity. And if AI progresses as one would expect, is it possible that we would be spending 10 or 20 million rand? Absolutely. If it's, you know, if it can start to do the things that human beings do and change our world so productively. So it's an absolutely fascinating phase. But importantly, investors are going, this is going to change the world. We're not quite sure exactly how it's going to work out, but we need to be invested. Investors have not got overexcited from a valuation point of view about the people who spend in the capex. So Alphabet, Microsoft, Apple, Amazon in aggregate are trading at kind of the average PE multiple or valuation as the market. They're not trading at massive premiums. So there's some skepticism being priced in, and they're actually fundamentally different businesses to what they were a few years ago. So they were giant cash flow machines, building up massive cash piles, paying out big dividends. They have now changed to infrastructure players.
Yeah.
You know, it's the exact opposite. They're spending money on capacity. But in the last Alphabet results last week, we saw their cloud spend, so their customers spent 86% more on, obviously not a real surprise, but a good number to see, because they're building all this capacity and they're saying they can't keep up with demand.
Yeah.
There's more demand than the enormous amounts of money that they're spending.
It's very interesting in that if you watch Palantir CEO Alex Karp, who is now on almost every single podcast he can get access to, talking about almost a pushback against these frontier labs and the business model of, say, a Claude or an Anthropic, where you, if you're inputting your data into these models and you're not using your own proprietary model, giving away your enterprise know-how and IP and secrets, and effectively opening yourself up to future competition from these businesses. And there does seem to be something of a growing concern in the US on the one hand, and then also on the other, this debate between open source and closed, which is very much almost a debate between the Western way of doing things and the Chinese way of doing things. Would you say that that makes investing maybe in the frontier labs, the Anthropics and the open AIs, a bit more risky, given that there is all of that uncertainty hanging over the business model of those companies?
Yeah, so the Anthropic and OpenAI, who are not listed, so you can't get burnt on them yet.
But they're going to IPO soon, apparently.
Yeah, sure. So that trajectory will be challenged by the stuff that you're talking about. But whether it's open source or closed like Anthropic, Claude, and OpenAI, if it's open, it requires more capacity. So whatever happens, it needs the computing capacity. And the more people are using it, it doesn't take away the need for the data center. What it does is who's going to make money and who's paying for it might change. But ourselves as a corporate, we've ultimately got to pay for that computing capacity. And that's where all the money is being spent and the money is being invested. You know, a simple Google search versus an OpenAI query is using between 10 to 20 times the computing capacity. And that's kind of the best way that I've found to explain it or to understand it. So all the tasks and everything we're asking it to do is using 20 times the amount of computer space in simple terms. You've also then got the SpaceX data centers in the sky. And, you know, so we're in the early stages of something that's growing rapidly and lots of questions, and it's evolving and it'll be very different a year from now. So diversifying our bets, but you want to have some chips on the table, to pardon the pun.
Pardon the pun. Let the chip makers fall where they may. But it's been remarkable just watching the likes of SK Hynix, Samsung drive the South Korean equity market, and Micron in the US. Let's come back to South African equities. And you said that's probably where you see quite an interesting opportunity. You forecast, I think, roughly 14% for South African equities over the next year. Break that return down for us. How much comes from different parts of the market, and where do you see the possible valuation re-ratings from here? We have been driven largely by commodities, or had been up until the 27th of February when Donald Trump decided to attack Iran. We've then seen gold, PGMs come back quite significantly. Where do you see a lot of that return coming from, Peter?
Yeah, so I think the easiest way in the kind of middle of the road be our banks and financial services, where if you think about they're trading on sort of 8p multiples on average, they're going to grow their earnings by about 10%, and there's about a 6% dividend yield. So the logic is, you know, they're pretty cheap. Let's assume that they stay cheap. You know, they stay at an 8p multiple in a year's time, but you've got 8 to 10% earnings growth and a 6% dividend yield. So you'd land up with a kind of a bad outcome would be a 10% return, a good outcome at 20%. So our market doesn't offer the same sort of excitement. And, you know, globally, you want to be invested because it can still go up 30%. You know, like you don't know where it's going to pan out. SA is more sort of chugging along, but we're growing. The companies are growing, and you've got pretty low valuations and good dividend yields. So we expect a decent return out of resources. All of this AI spend requires massive amounts of copper and certain resources. So there's quite a few drivers behind the resources space. And we're not expecting a massive year. But you've got the banks that are sitting with the equation that I talked about. And then industrial businesses chugging along at low valuations, but nonetheless growing. When the world returns to normal, oil comes back down to $60, interest rates come down, bond yields come down. That's good for equity valuations. So we were there, you know, in February this year, the party was on. All the stuff that I'm talking about was happening. Then the war started and we came off 15%. So, we're arguing that when things normalize again, you're going to have a bit of a bounce back. And it doesn't require too much to get that 15% return. It just requires a little bit of a return to normality and a bit of a risk appetite coming back. Investing in South Africa for a foreign investor is a risk call.
It is, and it, I suppose, to come to your earlier point, had been improving in our favour towards the back end of last year and into this year. Certainly interest rates coming down, a lot of the reform momentum starting to come through in real tangible improvements in running budget surpluses and improved credit ratings, getting off the grey list. All of those things really matter. Nolan, from where you're sitting, were you surprised by the Reserve Bank's decision to hold on interest rates last week? The market had broadly expected the hawks to dominate, which they have under Lesetja Kganyaga as governor's tenure. And we saw the rand weaken quite significantly after that. But is that an indication to you that this MPC is starting to be a little more sensitive to growth and aware of the limitations of trying to fight exogenous inflation shocks like oil prices with a blunt instrument like interest rates? And how does that then feed through into your domestic bond thesis?
Sure. So a lot to unpack there. And the truth is we're still wrestling a little bit with the MPC last week. It certainly was a shock and a surprise. I was actually chatting with Peter at the time the announcement came out, and all of us did a double take. I think the point I'd make is there were two elements to the shock. One, very much we expected a hike, but the other one was the MPC came out and said, look, the QPM model essentially is suggesting that I don't really need to hike again. And we kind of disagree with them a bit on that. When we look at the delta, what's the difference between our views? It comes down to the MPC was working on a sort of average oil price of $78 a barrel. And at the time of the MPC, was trading at about 100. So it's come down significantly, about 88 at the moment. So, from that perspective, they were seeing a more benign inflation environment than perhaps the market and ourselves were extrapolating. Looking forward, looking at the market reaction, looking at bond price reaction, it was almost as if the market shrugged and said, okay, well, we didn't get it now, but that's fine. We're going to get our hike in September. So I think the reaction was more to push the hike out by a quarter rather than to take it off the table. That being said, when you shock the market, there is a price to pay in the market, and the price to pay was 50 cents on the rand. So we saw the rand weakness come through in knee-jerk reaction to that. How do we interpret it going forward? I think that, it's the first time we've seen this MPC with a sort of current construct of participants talk about, push inflation rather than demand inflation, and talk about perhaps they don't need to hike rates. In fact, they think that policy is sufficiently restrictive. It's an unexpected stance from an MPC that we've always found to be quite hawkish. So from that perspective, a bit of a surprise. But I think that they'd be very cautious on, shocking us all a second time around. Market is pricing in 100% probability of a hike in September. And I think that our interpretation is we're very likely to get that, and potentially one into December if the war continues. What does that mean for bonds? I've openly been saying people are underestimating how quickly yields can come down. So from that perspective, whatever hikes we get in 2026, we probably see as cuts in 2027. So it's a very sort of short hiking and cutting cycle. And from our perspective, if the market's pricing in 3 interest rate hikes from today onwards, actually it's kind of priced in. And really what you want to do is position for the capital gains as the cuts come through later, because those cuts are not priced in yet. Yeah. But I think there's more and more likelihood that you're going to get into a cutting cycle mid to late next year. And this is a good opportunity to earn good interest income until you get capital gains.
Yeah, hard to argue against that. I think, there was a lot of talk of a wok-shaped recession following the Ukraine-Russia conflict in 2022. But what you're almost describing now is a Matterhorn type, short, sharp hike in rates, but then quickly coming back down. Coming to just broadly the South African macro, and I see Peter Anker expects further sovereign rating upgrades. And that's if the policy trajectory is maintained. That is going to be very welcome after being sub-investment grade for a very long time. We've still got some way to go. But if you chat to people who do lots of valuation work, and I think here of Dr. David Holland, for example, he reckons there is to the tune of somewhere in the region of 48 trillion rand that could be unlocked if we managed as a country to regain our investment grade rating, which would take several years. But how much of that improvement are you seeing already reflected in bond prices? Or do markets still remain a bit too bearish on the trajectory that South Africa seems to be on after so many years where it was very easy to be bearish on South Africa?
Yeah, I think we got a long way to go. I mean, a phrase I've used recently is absolutely bad and relatively good. We've coming off a very low base, and a lot of the ratings are being ticked up from quite a poor credit rating. We came off the grey list, so we're less bad than we were. There's still a hell of a long way to go, and a lot of years of execution of some of the things we decided to do. So, privatizing and letting private money come into things that need to get fixed and repairing some of the damage that's been done. So we're on a positive trajectory and curve, but it's giving us a projected GDP growth rate of 1 to 1.5%. That's very unexciting. Much better than the 0.5 of the last few years. So there's room to be more positive. And in fact, you're seeing it more in Nolan's bond yield than in my equity market. So guys are placing the easy bet and the liquid bet on bond yields, but they're not taking some of that money and putting it into SA companies yet, which is why we're arguing that the valuations are pretty cheap. But yeah, I mean, the ability we look in our client base, we look at the companies that we analyze, huge amounts of cash. If you could really just keep that going and get the confidence level to another stage, what can be unlocked is phenomenal.
Concluding quickfire round for both of you. So how would you be constructing a portfolio to take advantage of these themes globally and locally? What does that allocation look like for you and that spread across local and offshore and across the various asset classes from here? Peter?
I think be diversified. I think if you look at our projected returns from different asset classes, it's quite positive across the board, except for cash. You can get quite high yields. And as Nolan said, if the yields come down, there's some capital profit. We also think equity markets offer a reasonable mix. So today I had to do an allocation for a 10 million rand client. And we put about 35% into global equities, put some into bonds, some into alternatives, and 20% into local equity. So, we took quite a balanced view across the board, where the underlying yield or dividend yield is probably sitting at about 6 or 7. So it's a nice place to start. So if no valuations change. But you can get some quite nice kickers from bonds and equities because of what we're talking about today.
Yeah, it certainly sounds like that third quarter view is not that the risk has vanished, but that investors are being compensated for accepting selected risks in South African equities and long-dated government bonds. The global companies benefiting from that structural investment into AI and obviously alternatives, which we didn't have much time to talk about, but that are offering really nice, diversified and uncorrelated elements to a traditional portfolio as well. We'll have to leave it there. Thank you very much, Peter Armitage and Nolan Wapenaar of Anchor with their Where is the Money Going to Be Made in the Third Quarter Review here on the Monocle Banking Podcast. Remember to like, subscribe and share amongst your network. From me, Michael Avery. We'll see you same time next week.